The latest economic reports are telling a story that doesn't match reality on the ground. Experts are calling it a soft landing, a controlled deceleration, a healthy market correction. But if you actually look at what's happening in 15 specific American cities right now, you see something entirely different unfolding. Not a soft anything, a phase shift, the kind that starts quietly and ends with a lot of people wishing they'd paid attention sooner. Here's what the headlines won't tell you. The housing market isn't cooling uniformly. It's not stabilizing, it's cracking. And the cracks are appearing in places where millions of Americans made their biggest financial decisions based on assumptions that are no longer true. For the first time in years, we're not just seeing price moderation. We're seeing genuine price declines in major metropolitan areas. Not 2%, not 3%. Double-digit drops in specific neighborhoods and entire cities. And the people affected aren't just speculators or flippers, they're family, retirees, regular Americans who thought they were making the safest bet imaginable. The question isn't whether this is happening, it is. The real question is, how much worse does it get before it stabilizes? To understand what's changing, you have to understand what was. For nearly a generation, housing in America operated under a simple assumption: prices always go up. Maybe not every year, but over time, inexorably upward. Buy a home, pay your mortgage, watch it appreciate. That wasn't just optimism. That was the operating principle of an entire financial ecosystem. Like, real estate agents built their livelihoods on it. Banks designed lending around it. Families made life decisions based on it. Entire cities marketed themselves around it. And for the most part, from the 1990s through 2022, it worked. People who bought homes, even at seemingly high prices, watched them appreciate. Equity built, wealth accumulated, the American dream, tangible and real. This created a psychological framework that became almost religious in its certainty. Recessions came and went. The 2008 crisis was supposed to be the end of the housing market. It wasn't. Prices fell, people panicked, but within a few years, the narrative reasserted itself. Housing always comes back, always appreciates, always wins. That confidence became so embedded that when the pandemic hit and the Federal Reserve slashed interest rates to nearly zero, millions of Americans made a decision that felt almost inevitable. They'd buy homes, not eventually. Now, before prices went any higher, before they got priced out forever. This wasn't speculation. This was following the consensus wisdom of an entire generation. Between 2020 and 2022, that consensus wisdom created a real estate market unlike anything in modern history. Pandemic migration, historic low rates, limited inventory, stimulus payments. The perfect storm of conditions that made prices explode. In some cities, homes doubled in value in less than 3 years. People who bought felt brilliant. People who didn't buy felt regretful and desperate. But here's the thing about perfect storm: they pass. The shift began subtly. The Federal Reserve started raising interest rates in early 2022, then kept raising them, then raised them more. The goal was to fight inflation, but the consequence was immediate and brutal. Mortgage rates, which had been at 2 and 3%, climbed to 6, 7, and sometimes 8%. The math is simple, but the impact is devastation. A $500,000 home at 3% interest costs roughly $2,100 a month in mortgage payments. At 7%, it's $3,300. That's not a small difference. That's the difference between affordable and unaffordable for millions of families. Suddenly, the people who were priced out at 3% were still priced out at 7%. The people who stretched to afford homes at peak prices and historic low rates now found themselves in precarious position. Demand, which had seemed insatiable, evaporated. The migration wave that had been pulling people into secondary markets, Tampa, Austin, Phoenix, Denver, Charlotte, started to stall. Inventory, which had been scarce, started to accumulate. And for the first time in years, price momentum reversed. But it didn't reverse uniformly. And that's where the story gets concerning. In certain cities, prices didn't just level off, they fell hard. And they kept falling. Not the kind of modest corrections that get written off as healthy market adjustment. The kind of sustained declines that trap people in underwater mortgages and force difficult decisions. Austin, which had been the darling of the tech migration narrative, saw prices drop 12 to 15% from peak. Phoenix, which marketed itself as the affordable alternative to California, experienced similar pressures with declines in the 10 to 16% range. Tampa and Jacksonville, which had become synonymous with remote work migration, are down 10 to 14%. Yet at parts of Florida, where retirees were supposed to flock and build retirement security, are seeing double-digit declines in condo markets. But here's what makes this phase particularly dangerous. It's not just Sunbelt cities showing cracks. East Coast markets are starting to show pressure too. Parts of New Jersey, Connecticut, and Long Island are experiencing unexpected weakness. Markets that had held relatively stable are now seeing price stagnation and, in some cases, declines. The damage is starting to spread geographically, and the scariest part? We're early. This isn't the end of the decline. For many of these cities, this might be the middle or even the beginning. Why is this happening now? What specifically changed? The obvious answer is interest rates. Higher rates killed affordability. But there's more happening beneath that surface dynamic, and understanding it is crucial to understanding what comes next. First, the pandemic-driven narrative of permanent remote work is collapsing. Companies are calling people back to offices. The flexibility that justified moving from New York to Tampa or San Francisco to Austin is disappearing. People made geographic decisions based on temporary conditions. Now those conditions are reversing, but the real estate decisions are permanent. You can't undo buying a home. Second, the migration wave exhausted itself. There's only so much demand you can pull from other regions before you've pulled it. The people who were desperate to leave expensive coastal cities did so. The people who wanted to relocate for lifestyle found their places. After a while, you run out of migrant. And when the migration wave stops, the reason for price appreciation in those cities disappears. Third, speculative buying reached saturation. Investors and speculators flood into markets where they see appreciation. They're not buying homes to live in. They're buying them as investments. When appreciation stops, they sell. They sell aggressively because they have no emotional attachment. Their goal is to exit before prices fall further. And when investors flood the market with supply, when prices collapse faster, it becomes a cascade. Fourth, mortgage rates staying elevated longer than expected eliminated the refinancing escape route. Many people who stretched to buy homes at peak prices in 2021 and 2022 assumed they'd refinance when rates dropped. Rates haven't dropped significantly, they've stayed high, so the escape route is gone. Fifth, pandemic savings are depleted. The stimulus payments, the extra unemployment benefits, the deferred spending, it's all gone. Consumer finances are more fragile than they appear. Credit card debt is at all-time highs. Student loans restarted. The financial buffer that enabled risky home purchases has evaporated. And underneath all of this is a simple demographic reality. Younger generations have less wealth to make down payments. Older generations are aging and stepping back from buying. The traditional demand engines that have powered housing appreciation are weakening. This isn't one problem, it's a cascade of problems, all pointing in the same direction, and they're all hitting the same cities simultaneously. Now let's talk about what this actually means for real people, because that's where the story gets real. Consider David and Michelle, both 41, solid middle-class careers. In 2021, they sold their home in Chicago for $520,000 and bought in Austin for $650,000. They stretched their budget because everyone said Austin was the future. Tech jobs were flooding in. The market would only go higher. They put down 20%, took a $520,000 mortgage at a 2.8% rate. That math worked fine at 2.8%. Their payment was $2,180 a month, plus taxes and insurance and HOA fees. Tight but manageable. They felt smart. They were early to the Austin boom. Now, in 2026, their home is worth $565,000. They're underwater by $55,000 on the equity they brought to the table. More critically, if they wanted to sell today, they'd take a loss. That $130,000 down payment is now worth $75,000. More than half their down payment equity is gone. And they're still paying a mortgage for the next 27 years? They're not foreclosing. They have jobs. They can make payments, but they're trapped. They can't move for better opportunities without taking a massive financial hit. They can't refinance because their home is worth less than the mortgage. They're stuck in Austin, in a house they overpaid for, locked into a financial situation that felt safe and now feels precarious. David just learned his company is restructuring. There might be layoffs. If David's job disappears, they have a serious problem. One income can't sustain a $520,000 mortgage plus living expenses in a city where David's job prospects might be limited. This exact scenario is playing out in thousands of variations across 15 major cities right now. Families stretched at peak prices with low rates are now facing uncertain employment, elevated mortgage costs, and homes worth less than the mortgage. It's not a catastrophe yet, but it's incredibly fragile. Then there's Patricia, 59, who retired early and moved to Tampa in 2021. She bought a condo for $380,000, planning to downsize, simplify, and enjoy a lower cost of living. The condo was supposed to appreciate as Tampa filled with retirees and remote workers. Her retirement asset, security, a place to grow old. Her condo is now worth $340,000. She didn't lose a job. She didn't take on more mortgage. The market took her equity anyway. her retirement security just evaporated by $40,000. She's not in immediate danger. She can still afford to live there, but her retirement plan included selling and moving somewhere even cheaper in her late 60s. That plan is now harder. Now she might have to work another 3 to 5 years, or accept a lower standard of living than she anticipated. Or take Marcus, who bought 3 single-family homes in Phoenix between 2020 and 2022 as an investment portfolio. He spent nearly $1.3 million thinking appreciation plus rental income would create wealth. Rental income is solid, but his properties have lost approximately $250,000 in value collectively. He's not bankrupted, but he's in a position where he's no longer building wealth. He's maintaining losses. Every month he owns these properties is a month he's absorbing the cost of depreciation. He's considering selling to cut losses, but that locks in a $250,000 loss. Or he's considering holding, hoping for appreciation. But hoping isn't a strategy when you're sitting on negative equity with higher interest rate environment that makes refinancing impossible. These aren't theoretical people. These are thousands of families with similar stories, all trapped by the same dynamics, all concentrated in the same cities, all facing the same question. What now? The individual tragedy is real, but the systemic implication is even more concerning. When home equity evaporates, consumer psychology shifts. Home equity was a wealth accelerant. People felt wealthy because their homes were appreciating. That feeling funded spending, optimism, consumption. When equity evaporates, behavior reverses. People cut spending. They become conservative. They delay purchases, pause investments, reduce discretionary consumption. Into consumer spending is 70% of the American economy. When millions of people simultaneously lose faith in their largest asset, when they stop feeling wealthy, when they become financially conservative, it ripples through everything. Retail spending slows, service economies contract, entertainment spending declines, small businesses feel pressure, unemployment begins to rise. In these 15 cities, construction sectors boom when prices are rising. Builders, contractors, electricians, framers, inspectors, entire employment sectors exist in growth mode. When appreciation stops and prices start falling, construction halts. Speculatively built homes don't sell at expected prices. Builders cut projects or go bankrupt. And when construction stops, those jobs disappear. Workers leave, or they stay and underemploy. Services that depend on construction, local restaurants, supply chains, labor agencies, contract. Tax bases decline. Property taxes fund schools, infrastructure, emergency services. When home values fall, tax revenue falls. Cities that were in growth mode start making cuts. Schools lose funding. Infrastructure maintenance gets deferred. Public services decline. The city that was supposed to be the future starts showing signs of stagnation. Mortgage delinquency rates historically spike when home values fall below mortgage balances, especially when employment is uncertain. We're setting up the conditions for that to happen. It hasn't manifested at scale yet, but the structural conditions are present. Here's where most analysis stops, but here's where you need to think further. This housing phase shift isn't happening evenly across America. High-cost coastal markets, New York, San Francisco, Boston, Los Angeles, they're holding up better. Why? Because even with recent weakness, prices are so high that affordability is still the limiting factor. Supply is genuinely constrained. Jobs actually justify prices in these markets. Institutional wealth and international capital still find value there. They're more insulated. But these secondary and tertiary markets that exploded in the last 5 years, they're vulnerable because their appreciation was speculative, not fundamental. The job growth narrative was oversold. The cost of living advantage was smaller than advertised. Remote work turned out to be less permanent. Migration patterns are normalizing. When you remove speculation, what's left is cheaper real estate in cities with weaker job markets. That's not a bargain. That's a problem. But here's something counterintuitive that most people miss. This eventually stabilizes. Not at 2020 prices, not at peak 2022 prices, but somewhere in between where affordability returns and people stop losing equity every month. The question is how much further down prices fall before that stabilization happens. In some of these cities, we might be 40% of the way through the decline. In others, we could be 10% of the way through. That variance matters enormously for anyone holding assets in these markets. There's also a secondary housing market that's starting to show real weakness. Condos. Condos in urban cores and in retirement destinations were built speculatively at peak prices, marketed speculatively, and bought speculatively. speculatively. Now they're sitting with no appreciating narratives, expensive HOA fees, and declining demand. Some condo markets in Florida are down 15 to 20%. Urban condo markets in secondary cities are under pressure. Condo declines matter because they're concentrated in specific geographic areas and specific building stock. When an entire building has devalued units, the building starts to suffer. Maintenance gets deferred. Buildings deteriorate. This creates a death spiral where the neighborhood declines as buildings decline. People who are stuck in a depreciating condo in a declining building are in a particularly painful situation. So what should you actually understand about this phase shift? If you own in one of these 15 cities and you're considering selling, timing matters more than ever. The longer you wait, the lower the price you'll get. Yeah, there's no shame in selling at a loss if it prevents a bigger loss later. The window to exit with minimal damage is closing. If you're considering buying in these cities, you're probably early to the opportunity. Prices are likely to continue declining. Wait for the stabilization signal. When prices stop falling month after month, when inventory starts to tighten again, when job growth re-accelerates, that's when you buy. Don't buy falling knives hoping to catch them before they hit the ground. The ground is still a ways down. If you're in a high-cost market watching this happen elsewhere and feeling relieved you didn't jump into the secondary market gold rush, understand that these patterns eventually spread. Not immediately, but they do. Market sentiment shifts, migration reverses, confidence decline. These aren't isolated events. They're symptoms of a broader phase shift in how Americans think about housing. If you're renting right now and you've been considering buying, pause. Let this phase play out. Rent, build capital, watch the market stabilize. There's no rush. You're not going to miss the opportunity of a lifetime. You're going to miss the last days of a bubble, which is exactly what you should do. The deeper implication is that American housing is entering a phase where appreciation is not guaranteed, not for a cycle, but fundamentally. We might be entering a period where homes appreciate slower than inflation, where geographic variations matter enormously, and where buying the right home in the right place is actually difficult and risky again. For a generation, that wasn't true. You bought anything, anywhere, and it appreciated. That era is ending. We're transitioning to a more normal market where location matters, where job growth matters, where fundamentals matter. Some cities will appreciate, some will stagnate, some will decline for years. The people who understood this transition early will do well. The people who are still operating under the housing always goes up assumption will get hurt. Some are already getting hurt. The housing market hasn't collapsed. There's no panic, no crash, but it has entered a dangerous phase. 15 cities are showing cracks. Millions of people are trapped in bad financial positions. Equity is evaporating. Psychology is shifting, and the pain is only starting to propagate outward. We're at the moment where headlines still say everything is fine. But if you actually look at what's happening in the neighborhoods where millions of Americans live, you see something entirely different. You see a phase shift. You see assumptions breaking. You see people wishing they'd paid closer attention sooner. The time to pay attention is now. Before the cracks spread to your city, before the migration narrative that drove prices higher reverses completely, before the jobs that justified the prices start disappearing, before you become one of the thousands of families wondering how you got trapped in a home worth less than your mortgage in a city that's starting to decline. The housing market is changing. The cities showing cracks right now are just the beginning. And if you see the pattern early, you can make decisions that protect you. If you don't, you'll be making those decisions years from now when it's much harder and much more expensive.